going to share my screen. Can you see the slides?
Yes.
Okay. Good afternoon, everybody. Thanks for your interest today. I'm going to introduce quickly the issue of financeability for transmission investments in Europe. This is a work that has been first developed in a previous study. You can find the related working paper on our website, and I encourage you to have a look. I'm going to present an updated version of this study, which is based on the 10-year Network Development Plan 2014, published by the ENTSO-E. So first of all, what is the financeability challenge? Well, TSOs must realize investments in the transmission networks. They must do so to replace aging infrastructure. They also must achieve investments to expand the network, connect new generators, increase the level of interconnection between neighboring member states. In theory, depreciation should be sufficient to cover the investment required to replace existing infrastructure. But sometimes, and this is the situation we face today, depreciation that is included in tariff revenues is not sufficient to cover the need for significant new investments. To cover this gap between a return based on past investments and new needs, the TSOs can use three different resources. A first resource is retained earnings. The TSO can keep a share of its profits and reinvest them into the transmission network. These retained earnings are limited. They are limited because the profits of the TSO are limited, and their retained earnings are also limited because a significant share of the profits must be returned to the TSO owners under the form of dividend. So retained earnings will not be sufficient today to cover the need for cash flow. The other resource that TSO can use to fill this gap is equity injection by the current owners of the TSO or by new investors. But for a set of political and economical reasons, there is very little equity injection in Europe today. So, since liberalization, TSOs have traditionally met the need for new investment by emitting debt. The problem is that today the level of debt is quite high. We will see later on that for a European TSO it will be close to 70%. So there are also limits on this amount of debt. So this is our financeability challenge, how to fill the gap between a return based on past investments and new needs, while the free resources are limited. In order to assess this financeability challenge, we use a methodology that has been developed by Moody's. And we focus on two quantitative indicators that reflect the ability of the TSO to pay interest and the amount of debt compared to the value of a TSO. So these indicators reflect what investors look at when lending money to a TSO, when investing into a TSO. And we define financeability as the ability of the TSO to fund the investment plans while conserving a good financial profile, while conserving an investment grade. So this is how we define financeability. In our study, we look at the ENTSO-E area, and we look at it over the period 2014-2030 that is covered within the TYNDP 2014. We make a significant assumption. We make the assumption that there is a single aggregated TSO that covers all the ENTSO-E area. Of course, it's a strong assumption, and you can see more details on its rationale in the working paper. But what you can keep in mind is that in our study, we only look at the first level of constraint at the scale of the European industry. The situation may be different for smaller TSOs with higher investment needs, but we will see that already this first level of constraint is sufficient to see some constraints appearing. One of the novelties of the TYNDP 2014 is that it features 4 different visions. These visions differ in terms of integration of the internal electricity market, in terms of progress compared to the Energy Roadmap 2050. Of course, we cannot represent all the different aspects of these visions in our simple model, but we take them into account by looking at the evolution of energy consumption and peak demand in these different visions, and by looking at different investment programs. For the most ambitious visions, Vision 3 and 4, we consider that the amount of projects of common interest is close to 150 billion euro, while in the less ambitious visions, it is only 125 billion euro. This is for projects of common interest only. We use these figures as an input to our balance sheet model. In addition to these projects of common interest, we also include the replacement of existing assets. This is data that is provided by the IEA in its World Energy Outlook 2011. And you can see that this figure is a bit smaller than the one of projects of common interest, but it's not negligible. So this is our investment scenario. We also need a no change scenario. What is the business as usual financing strategy of the TSO? Well, we have said previously that there is very little equity injection in the European TSOs today, so we consider there is no equity injection at all. If we measure the gearing of a European aggregated TSO today, based on the annual reports of the TSOs, it's close to 70%. TSOs traditionally emit a high share of their profits as dividends, so the 70% of the earnings are distributed to equity owners. And if we look at the level of tariffs today, it would be close to 7% for return on asset and 10% for the return on equity. And finally, in our no change scenario, we make the assumption that network tariffs can only increase by inflation plus 1% every year, which reflects the current trend and the sectorial inflation of TSOs. So this is our no change scenario, and then we run it in a balance sheet modeling. And the conclusion is very clear. The no change scenario is not sustainable in the long term, and it's even not sustainable in the short term. So very quickly, European TSO trying to achieve the whole TYNDP would lose its investment grade. It means that in the no change scenario, it is not possible for the TSOs to achieve the full TYNDP. What is the share they can actually achieve? Well, you can see the results on this slide. You can see that depending on the visions, the TSOs could achieve between half and 2/3 of the TYNDP. There are two things to keep in mind when looking at these figures. The first one is that all these projects have been through cost-benefit analysis. They all unlock benefits in terms of social welfare, in terms of reduction of carbon emission, of integration of renewables. So not achieving this project will have, as a consequence, a reduction of the social welfare. And the second thing to keep in mind is that we only include here the projects of common interest and the replacement of existing infrastructure. There are many projects of national and regional interest that are not included. And so the share of the total package, total investment package that can be achieved is much smaller. The main problem we have in our no change scenario is that the debt is increasing too quickly. And we have to keep a balance between debt and injections of internal or external equity. A first way to keep a balance is to lower the amount of debt that is required by lowering the investment package. And this is what we have just seen. But what if we want to unlock the benefits of the TYNDP and we want to achieve the full package? Well, there are natural variants that come to mind. A first one is to increase the revenues of the TSOs to allow them to cope with the new investment needs. A second option is that the revenues stay the same, but TSOs conserve a higher share of these revenues to reinvest them into the transmission network. So in the first situation, we keep the same share of a higher pie, and in the second situation, we keep a higher share of the same pie. So these are ways to conserve earnings and inject equity internally into the TSO. But it's also possible to find new investors or current investors that are willing to inject more equity, and hence to find equity sources that are external. So now we will have a look at these different variants. The simplest one, apart from not achieving the full package, is to simply increase tariffs until we can cover the whole investment package while conserving an investment grade. So these are the figures for the 4 different visions to achieve the whole TYNDP. You can see that it's close to 2% per year on top of inflation, which is not significant. But you have to remember that this is only the projects of common interest. If we also include the projects of national and regional interest, we can make the assumption that the total investment package will be about twice the TYNDP. And you can see that in this case, the increase in tariffs that will be required to achieve the full TYNDP, the full investment package, while conserving an investment grade, will be between 5% and 8% increase every year. This is a very significant increase, and it will probably lead to problems of acceptability of increase in tariffs. So we have a problem of affordability of the investment package. But what if we try to use alternative financing strategies? Here you can see on this figure what will be the required increase in tariffs for a set of constraints. First of all, we want to achieve the full TYNDP. Second, we want to conserve an investment grade. And third, we want to keep a good return on equity to attract equity injections into the TSOs. And you can see what is the required increase in tariffs annually for different amount of equity injection. Initially, by injecting a bit of equity, it is possible to release the constraints of the financial ratios, and therefore to achieve the TYNDP and conserve an investment grade for smaller increase in tariffs. But when we pass the optimal threshold, as equity is more expensive than debt, it becomes more expensive to inject further equity. Well, the good news is that we can see that by fine-tuning a bit the financing strategy of the TSO, it is possible to reduce the required increase in tariffs. But you can see that it's only possible to a small extent, and that the required increase in tariff will be high anyway. If we looked at the results for lower dividends payout, we would have exactly the same results, because it's equivalent to injecting internal equity instead of external equity. So we get the same kind of results. It's possible to do a bit, but not that much. So I've tried to introduce many results and many figures in 10 minutes. What are the key messages you can take away from this presentation? First of all, an increase in tariffs is unavoidable. And if we consider that the TYNDP is only half the total investment package, we see that the increase in tariffs that will be required will be between 5 and 8% per year. This is very significant, and for sure we would have an acceptability problem. So there is an affordability issue of the investment package. But if these investments are valuable, if we want to unlock their benefits, we have to accept the increase in tariffs. We have also seen that by injecting a small amount of equity or by reducing a bit the payout ratio, we could reduce the required increase in tariffs, but this is only possible to a small extent. It's not a miracle solution. We cannot reduce the required increase in tariff when investments increase significantly. But in this study, what we did is that we focused on the quantitative indicators that are used by Moody's. There is a major share of the rating that is based on qualitative indicators. And in particular, the regulatory framework plays an important role in the way investors look at TSOs as an investment. So I will now give the floor back to Vincent, who will talk a bit further about this regulatory framework.
Thank you very much.
I'm looking forward to your questions.
Thank you very much, Arthur. I would like to remind you that you can already submit your questions. And now, Vincent.
Thank you, Arthur. Thank you, Cara. I will share my presentation. That's okay. You see my presentation?
Not yet. No, we still see you.
Is it okay?
Okay, now yes.
No.
Perfect.
Okay. Thank you very much. Good morning to everybody. Good afternoon to everybody. So after the financial diagnosis of Arthur, I now propose you to make a diagnosis of the current regulations to question whether they are able to finance transmission investment, and if not, what are the possible solutions. That's a work we're doing now almost more than 1 year ago with Florence School of Regulation and with TSOs in this area. I recommend you to go and see the policy briefs we have done on this topic and the report we worked on this topic if you want to have more detail, and it's also a work we have expanded for the presentation I will do to you right now. So in terms of context, so the presentation of Arthur shown us that there is a financeability issue for TSOs to develop the required 100 billion euro of electricity transmission investment in Europe. And this is also in a context where incentive regulation is more and more used by regulators. From a historical point of view, they applied it to optimize OPEX. It was efficient in a period of low investment because optimizing OPEX was then the main variable that can be activated to control the tariff level. Nevertheless, the impact of the tariff setting and incentive regulation on financing costs was not so much investigated. Where did it have a major impact on the effective remuneration level of TSO? For instance, in the UK, incentive regulation may increase or decrease the effective remuneration level of TSOs by 40%, more or less. And in another example, in the Netherlands, it may decrease the effective remuneration level of the TSO by 30%. So it is not neglectable to look at incentive regulation. And this, of course, may impact the perception of financial costs of TSOs by financial market, which may search for the most attractive investment, in particular in the area of energy infrastructures. So in order to propose an adequate solution to the current situation, it is essential to make a diagnosis of the current regulation with this regard, and done so comparing national regulation in the Northwest region, looking at the regulatory regimes in Belgium, France, Germany, Great Britain, the Netherlands, Norway, Sweden, and Finland. These countries are now integrated in a common market with other countries that we have not looked at for the moment. And they stand for 3/4 of the European production, the European consumption of electricity. And for all of them, we have looked at the current regulatory paradigm. So to do the diagnosis, we propose to compare them on two axes that are of importance for investors when evaluating the regulatory environment. The horizontal axis stands for the basic remuneration level for investments, the regulated WACC level, and the vertical axis represents the risk remuneration for TSOs resulting from the incentive regulation for cost reduction. Consequently, regulatory regimes located in the lower shaded part of this graph will provide higher incentives for investment. They will also be more attractive for shareholders because they generate more benefit. And with more capital offer from candidate shareholders in the financial market, these regulatory regimes will also produce lower financing costs for TSOs. Well, but at the extreme, these regulatory regimes also encompass a risk of gold plating because they may incentivize the TSO to do overinvestment. Inversely, regulatory regimes that are located in the upper shaded part of the graph will provide a high incentive for cost reduction and also shorter benefits for final users with lower tariff in the short run. But they endanger the TSO financeability because incentive regulation may reduce the effective remuneration level. And at the extreme, with a lower remuneration level, the financial cost may be higher, and this regime so encompass a risk of underinvestment because the TSO will have difficulty to finance them. So to keep on with our diagnosis, we propose to place the regulatory regimes in this figure, and we have done so in a qualitative way. A quantitative analysis would be far more demanding, but also far more useful with this regard. That's why we're pushing for this kind of analysis. So we can see that there's countries with high remuneration and risk remuneration from incentive regulation that are Norway and Great Britain. Sweden is in a situation where it has less risk, but its regime had been appealed, so its evaluation should be regarded with caution. France and Finland have lower remuneration, and Germany, is facing higher risk. And Belgium and the Netherlands are the countries where the basic remuneration level is lower, with a higher risk from incentive regulation in the Netherlands. So we can notice the heterogeneity of the regulatory regimes, while the investment challenge is the same, is a common problem at the European level for all these TSOs. Besides, there is a general movement toward more incentive regulation if you compare the evolution of the last regulatory period and the current regulatory period. And at the same time, there is an uncertain movement between the regulators about the remuneration level. Some regulators are increasing or maintaining the remuneration level, or others are decreasing the remuneration level because of low rates on the financial market. The alignment of regulatory regime should be done considering the current situation in Europe. We are facing huge investment needs. This will, of course, increase the demand on the financial market, and so increase the financing cost. And we are also facing with a cost of having no investment that we expect that is expected to be higher than overinvestment, as Arthur mentioned it previously. So considering this situation, the target for regulation should be in a zone more favorable for investment. The goal is to reduce the cost of capital. This is because it has now an impact that is higher on network tariffs than operating costs. This is because we are in a phase of major investment. So having less risky regulatory regimes and better remuneration for TSO. Well, of course, there are national priorities too, and this may call for a target zone for the regulation that is sufficiently large to incorporate these national priorities. And also more generally, well, that's here an illustration, and we think that there is a need to investigate where this target should be, evaluating the precise impact of uncertainty from incentive regulation on effective remuneration level and also on financing costs of TSOs. I'm now almost at the conclusion of my presentation, and to end it, I propose here some solutions that are not necessarily very exhaustive, but there are possible solutions to food for thought to begin the discussion. So a first solution is to increase the remuneration, because this will lower financing costs, attracting financial investors. And a way of doing it is to keep the regulated WACC at a stable value and not making it go back and forth with the movement on risk-free rate, all the more than this rate are for, let's say, short-term product compared to the lifespan of network assets. So short product for 10 years, final product for 10 years, whereas assets are here for 40 years. A possible solution also could be to make a difference between the remuneration of old and new assets. If there is structural changes in the rates for remuneration of these assets, so that's a possibility, taking into account also the lifespan of the assets. Also, well, a possibility, and we see this happening in some regulation, to introduce different remuneration level for different types of investment, more or less taking into account the social value of this investment to have give a higher value for more strategic investments. So that's how different investment premium could be added to the related remuneration. Another basic solution is to take into account financeability in the way to set WACC, the regulated WACC by the regulator. For the moment, generally, the regulator is not looking at this financeability issue at all. There's the exception in the UK, but otherwise that's not a problem. And also, this is also a point that I mentioned in the next slide. Well, for applying efficiency target in the framework on incentive regulation, it should be applied on controllable sets on OPEX and on new investments, and not on stranded cost, as we can see some regulator be tempted to do. As for incentive regulation, where for benchmarking, it is a useful tool to find information, but for the moment it should be used as an information tool because there are some elements that are not well integrated in our view in this incentive regulatory tool. So focus on controllable costs, as I mentioned previously, and also for long regulatory period, fine-tune uncertainty and adjustment mechanisms that make evolve the revenue considering uncertainty in the remuneration of the TSO. So I've done with my presentation. Now I welcome comments, questions, and to discuss it with Arthur right now.
Thank you, Vincent. And thank you to all of you for joining us. Now it's your turn, so I'm looking at your questions. Maybe Arthur, would you like to tackle some questions?
Yeah, I will start with the first one. So the one saying that transmission tariffs are only a small part of the total bill, and is it then an increase in tariffs such a big issue? It's true that transmission tariffs are only a small part of the bill, and it's true that the electricity bills are increasing for many other reasons today, and in particular the support to renewables. But I don't think it's a reason to say that we should not care about this issue, that consumers will not see the difference. We are talking of increases in tariffs of 5 to 8% per year. It's very significant, and it leads to doubling the share of transmission tariffs very quickly. So it's a big issue, even if it's a small share of the bill. And if we think, for instance, of the electricity-intensive industry, such a difference can really make the difference between a positive or a negative margin. So to my mind, there are other issues that should be kept in mind, but still an increase in transmission tariffs is a big issue, yes.
Thank you, Arthur. So Vincent, which question would you like to tackle?
Let's first talk about benchmarking, because I just undid it. It was at the very end of my presentation. So, well, of course, benchmarking is very useful to cope with the with the problem of information asymmetry for TSOs, for regulators, excuse me. But it's very useful when for one regulator, when dealing with several companies that is in charge of regulation. But when doing benchmarking on different TSOs with different regulators, in fact, you are doing benchmarking on this couple, TSO plus regulation, and not on the TSOs themselves. For the moment, there is no to my knowledge, the regulations are not controlled in the benchmarking applied to the TSO. In my mind, they should be, at least to some extent. Not only the current regulation, but also the past regulation, because the TSOs have developed their network based on what based on the regulations they were faced with some years ago. And well, since you have lots of stranded costs in a company like a TSO, this should be taken into account when doing a benchmarking.
Thank you, Vincent. And now, Arthur, what do you see as interesting?
I will take two questions because there is a clarification question on the investments, the investment scenario that I include in the simulation. So to make it short, we take into account only the projects of common interest. There's a difference between the TYNDP, the previous TYNDP, and the TYNDP 2014. Because previously projects of regional interest were also included in the TYNDP, while today they are not anymore. So short answer is it's only projects of common interest, but it's also the TYNDP 2014.
Okay.
So I will answer also the question on cost coverage by tariff.
Yes.
Okay, so yes, it's true. We are talking here about two partially different things. I have said in the introduction that in theory, the depreciation should be sufficient to cover the replacement of existing assets. When we have a significant amount of new investments, we need to fill the gap with debt and equity. But these two, so it doesn't mean that retained earnings and depreciation are not an alternative to debt and equity, because retained earnings can be seen as a source of internal equity. And it can be used, it can be reinvested by the TSO's owners into the network. So to this extent, retained earnings is an alternative to injection of equity of new equity by the current owners, or equity by new investors.
Thank you very much. Let me remind you that you can submit your questions using the Q&A panel, which is hidden in the menu on the top right of your screen. So I encourage you to take this opportunity. Vincent, would you like to address this question?
Yeah, of course. Yeah. So for sure, there are not so much debt issue for 40 years, but there are some debt that are issued for a long period of time. There was debt or obligation issued for 40 or even 100 years. Well, there are some possibility. The problem with this kind of product is that they are not very liquid, of course. But when we look at the rate, there is when we look at the demand for this kind of product and then at the rate, well, first there is a demand that is quite high for this kind of product. So there are some financial institutions that are willing to have this kind of debt for long term because they are attractive in their portfolio. And also when we look at the rate, well, they are not. We see clearly that for the moment the short-term rate is below the long-term level of short-term rate. So of course we could have a behavior relying on some kind of opportunism, saying, well, we rely on the small on this low level of rates, and so we put them into the tariff. But then if we rely on short-term rates, what would happen when the rate will increase once again? So do you think that the regulator will have a symmetric behavior when the rate will be higher than their long-term trend? Knowing that the regulator may have this kind of hold-up behavior, meaning that they will not integrate the higher level of rates when they will be higher than the long-term trend, then I would really recommend that we keep some stable WACC level, because we are long-term with long-term assets, and normally we should have an alignment between the lifetime of these assets and the rate and even the type of debt that could be issued otherwise. And if there is a reliance on short-term product, we can expect also that this will not be the credit rating agencies will not be very fond of it, because they also consider that it is a source of risk for the TSO. So this may also impact their evaluation of grade for the TSOs.
Thank you, Vincent. I see another question.
Maybe I will take this one.
Okay.
Well, it's some things that I have heard a couple of times when making this presentation, that it's if TSOs cut completely dividends and these are kept to be reinvested into the TSOs, we could solve part of the financing issue. The first thing is that for an investor, it's not equivalent to see to get some dividends in cash or to see this money reinvested into the TSO. There are some theoretical some theories like the Modigliani-Miller theorem that say that it should be equivalent, but when you look at in practice, the investors prefer to receive dividends. This is true in general. It's especially true for the TSOs. So we know that investors into TSOs look at a significant payout ratio. They look at the dividends emitted, and they traditionally want between 5 and 7% return on equity under the form of dividends. So there are some limits in the acceptability of cutting dividends. And apart from this acceptability issue, it is also important to understand that by reinvesting the dividends into the TSO, we increase the amount of equity into the TSO. And we go back to the issue that we have seen in the last slide of the presentation, which is that investors who own equity traditionally require a higher return than debt. And it is unlikely that increasing too much the amount of equity into the TSOs would allow the tariffs not to increase significantly. At one point, it becomes costly to inject more equity, and this is the case when we cut dividends completely. So, to sum it up, there is a problem of acceptability of cutting dividends, and it will be a costly policy. It can do we can do a bit of fine-tuning by reducing a bit the amount of dividends, but we cannot cut them completely.
Thank you, Arthur. So we have only 5 minutes left. Don't be shy. It's your opportunity. So if you want to ask something more, now it's the moment. Would you like to add something more while waiting for questions?
That was one question. So about the regulatory regimes, yeah, of course, the regulatory regime, they were built in a national context, considering let's say the national need of investment, the cost of capital for TSO, the efficiency gains asked in the past to TSOs. Of course, they have impacted the regulatory regimes in the long run. In the past, let's say, they also have impacted, I think, the network how it is right now. That's what also I mentioned previously, that benchmarking should be done in a more careful way than it is currently done. But well, this does not does not change, excuse me, what we are looking about the problem of financeability. You have to take into account the past of TSOs. For instance, Arthur has shown that the fact that TSOs are already with a high amount of debt raise some problem for them to increase this amount of debt. This should be taken into account by the regulators in doing their regulation, in taking into account in setting the WACC. So, well, this should be taken into account for sure, but this does not change the fact that we need investment and that we still have this financeability problem. This is a part of the problem, the fact that in the past there was already a quite high reliance on debt, and it is right now difficult for the TSO to issue more debt with this regard.
Thank you, Vincent. So, just I would like to thank you all, and I will be very, very happy to receive all your comments. And I will say, if you have any other questions, you can contact directly our speakers, Arthur and Vincent. And thank you, Arthur, thank you, Vincent, to be today with me, and to all of you for having been with us.